Hello, this is the capital budgeting video for what I would call the financial forecasting component. We're going to look at Project Z, which is not on the list, but it's very similar to the ones that you see in the problem. From the description that we have here, I've already put a lot of that information in, as you see here. The project has an initial investment of $2 million. You see I have $2 million in the initial cost. You see that the installation cost is $150,000. You see that there. And then I have units sold, 90,000 units just across the board. I have the depreciation rates. That's from the assignment. I went ahead and plugged those in. And so I have the tax rate. The required return, this number right here, we do not have it because that is the weighted average cost of capital with some type of risk adjustment. And actually, as we see here in the assignment, it says, because this project is very close to current products sold by the business, management has expressed some favoritism toward this product and has allowed for a reduced rate of 2 percentage points below the current WACC. So let's say that if the WACC happened to be 13%, then the required return would be the 13% minus 0.02, and we would get 11%. So what I would do here is I would want to make sure that I have a good model in place so I can calculate the cash flows. So one of the first things I would do, I would take the unit sold, I would multiply it by the price. I would then go in and make sure that I anchor down the price there. Same thing with variable cost. I would take the units times the variable cost. I would go through that and anchor the variable cost component. Fixed cost, which is just this value here. Again, I would make sure that that is anchored. We have some formatting here, so let me change some of the formatting just to make sure that we are all in the right color. So we have that. So then our EBITDA would be the sales minus the variable cost minus the fixed cost. Then depreciation, what I would need to do is identify the depreciable amount. One way that I could do that would be to actually look at the capital spending outflow in year 0, which would be the $2 million plus the installation cost. And so then what I could do is take that 20%, multiply it by this, and get that value. Again, I would want to make sure that I have some cells anchored. That would give me my EBIT, which gives me earnings before interest and tax. There's no interest applied in this scenario, even though there are bonds out there that's not going to be applicable here. So then I would just take that times the tax rate, get that value there, and then that's minus this, and I would get that. Because I have anchored the certain cells, I can click and drag this over and get all of the various pieces of information. Apparently I did not, I needed to have anchored that cell there. And so we see that value there. Actually, we see in this scenario, we actually have negative income. So tell you what, I'm just going to, for the purposes of keeping things equal, let's just increase the units sold here. I guess I'm going to have to go up to 100,000 to get something even, and then that way we at least have positive cash flows for this example. So then what I would want to look for is operational cash flow. If you remember back to the text, operational cash flow, a couple different ways that you can do that, but net income plus your depreciation gets you the quickest one. Of course, you have to hit the right functions to make that work for you. So you have that there. There wouldn't be a operational cash flow in year 0 because there's no operations in year 0. And then also, since you've spent all of your capital in year 0, you wouldn't need anything in years 1 through 5. Now there would be the after-tax salvage cost in year 6, and so you would have a value there. So then, what you could do is just take this and drag it over and start adding in those values. Net working capital, we see an increase in net working capital of 250,000. You wouldn't have anything. There's no changes in future years for years 1 through 5. But in year 6, you would recoup that. So you would want to see that value again. And then total cash flows. Now this is where I want to point out something, is that in year 0, you would want to make sure that all of these are negative, because you want to make sure that your cash outflows are appropriate there. And then, you can calculate your positive cash flows this way. Calculate all of those over like that. And then your after-tax cash flows, what you would want to do is look at the salvage value times 1 minus the tax rate. If you remember back to that, you have that there. And so this gives you, and then of course cumulative would just be, you would start with that same amount here and then just start adding to the previous, and so that would give you some numbers there. And then that would allow you to calculate your IRR, net present value, profitability index, payback period. Let me just show you how to do internal rate of return because it's the simplest of the ones. Of course, we go to here, just so happens that it's down there at the bottom. And all it really wants is these values here. And so we see that our internal rate of return is 11.34. So almost, just barely over the required return, but we would accept it because it is. So hopefully this helps you, point you in the right direction as you start doing the rest of the assignment.